David Blain. A discussion about your money, including everything from investing and taxes to real estate. Now with this week's program from D.L. Blain and Company in New Bern, here's David Blain.
Hello and welcome to All Things Money. I'm your host for today's show, David Blain, as always. And if you have any comments or questions on the show, I'd like to give out our contact information as we get started here. The phone number is 252-633-0107. Our email is allthingsmoney@dlblain.com. And you can visit us on the web at www.dlblain.com. There you'll find information about myself, my firm, as well as archived copies of the show. And I know that a lot of you, wherever I go out in town in New Bern, people are always coming up to me saying, "Hey, I heard you on 94.1 FM," or "I saw you on cable TV 10, and please continue to do so." I love to get the feedback, what you liked about the show, what segments were informative, which ones you didn't like, other topics. So the show is about you and your money, so we like to present things that are interesting to you, not just what I want to talk about. So a lot of talk shows that I listen to, it seems like the person is, just talking about whatever they want to hear themselves talk about. Well, we try to present topics and things that you're interested in. So the only way we know is by you letting us know. We get some feedback from our clients, of course, as well for ideas for the show. So without further ado, let's get right into it. Last week, I started talking about a paper that I read recently by James Montier at GMO. GMO is a large institutional money manager, Grantham Mayer Otterloo or something. Jeremy Grantham is an old-time Wall Street investor. He's been around forever. He's got a lot of experience. And I like to study these people, their firms, what the information that they write. And James put out a piece called The 7 Immutable Laws of Investing. And it's nothing that he made up. This is sort of not common knowledge, but in the world of value investing, it's very common, these principles. Benjamin Graham, the father of value investing, if you read his book, The Intelligent Investor, and other books, you will see these laws permeate. But James put it together in a nice format, so we're going to kind of follow his format. Maybe some other day I'll bring in some of Ben Graham's books, and we'll go through them. Security Analysis, Graham and Dodd is, it's a book probably 6 inches thick that's sort of the Bible of value investing, some great information. So we started talking about the first rule, which is always insist on a margin of safety. I'm not going to go over that completely, but I started off talking about a Fortune magazine article in 2000 that gave people the 10 stocks for the next decade to invest in. Names such as Nokia, Nortel, Enron, Oracle, Broadcom, Viacom, Univision, Schwab, Morgan Stanley, and Genentech. And of course, if you invested $100 in these 10 companies today, they would be worth about $30. So what was wrong with their predictions? Well, among other things, they didn't insist on a margin of safety. The PE, or price to earnings ratio, a measure of the valuation of the stocks, was astronomical. That the average PE was in triple digits, over 100. This is extremely high valuation. When you go to the grocery store, there's a price on the gallon of milk. It says $4 a gallon. And you have to sort of make a decision. Well, is that $4 for the gallon of milk worth the enjoyment that I'm going to get from drinking a glass of milk or putting it into a cake? And so that's kind of how you do valuation. You have a price, but then you have the value of the milk. And if it was $20 a gallon, you would say, well, I think I'll get by with some water. Well, stocks are the same thing. They have a price on them, which is what you look up on the internet, or for the old timers, what you look up in the newspaper, and Apple is $400 a share. Well, what's the value of it? What is it worth to you? And generally, what you should be looking at is what it's worth is based on the earnings that company can create. Hence the term PE, price divided by earnings. It gives you a gauge as to the value of whether this particular company or even stock market is expensive or cheap. And all things considered, we like to buy cheap assets. We like things on sale. Now, we don't necessarily like things that are on sale because the company's going bankrupt. If you buy some TV from a company that's going bankrupt, there's going to be no warranty service. The same thing with a stock, because we don't want to buy things just because they're cheap. They may end up being Citigroup or GM or something, and they go bankrupt and you're completely wiped out. So margin of safety is somewhat of an elusive concept, but it's very important, and it applies not just to individual stocks, but more importantly to markets. The S&P 500, the FTSE 100 in the United Kingdom, the Hang Seng in Hong Kong, the BSE in India. Different stock markets as an aggregate have a PE ratio. So we're going to look at some things on margin of safety, just talk about a couple of concepts. The first one, one of the main reasons, why do you want this margin of safety? Well, because in the long term, it's what determines your rate of return. In the short term, there are a lot of things that determine returns. Trends do exist in markets. Trends can go along for a long time. But over the long term, we think that valuation is still the number one thing in the long term that will determine the return of investments. And if we look at, we got some data here from 1881, the stock markets from 1881 in the U.S. We look at when the market has been the cheapest 20% of the time, meaning its average PE is 8.6, meaning you're paying about 8 times 1 year's worth of earnings for the stock. Its return has been almost 11% over the next 10 years. And if you think of kind of a stair steps, you've got the cheapest 20%, the next 20%, the next 20%, the next 20%, like a descending staircase. That's exactly the way the returns line up. If you look at the cheapest 20% of the time, going down to the most expensive 20% of the time, when the average PE has been about 24.6%, the average return over the next decade has only been 2.4%. So it's almost a perfect staircase. From the cheapest down to the most expensive, you get more return when you start investing or you purchase markets when they are the cheapest. When we come back, we'll take a look at some other measures of valuation, looking at this concept of PE to help solidify this concept of margin of safety. It applies to both stocks and bonds, but we're taking a look at stocks right now. So let's get a few messages in from our sponsors, and when we come back, we'll continue with the discussion. For All Things Money, I'm David Blain.